This voice is taken from an article with the title, "What is the Impact of Central Bank Interventions on Currency Markets?" which has been published on TRADERTALKSNET. Central bank interventions in currency markets have become increasingly common in recent years as central banks have sought to stabilize their currencies. Interventions can take a variety of forms, from direct purchases of forex currency to indirect measures such as setting interest rates. The primary objective of central bank interventions is to stabilize the exchange rate of their currency against other currencies. Interventions can be effective if they are executed in a timely manner, with sufficient resources and with appropriate coordination. Central banks can intervene to prevent a currency from depreciating too rapidly, to prevent a currency from appreciating too rapidly, and to stabilize the overall exchange rate. When intervening in the currency markets, central banks seek to influence the supply and demand of a currency. This is done by buying or selling the currency in the spot and/or forward markets. By buying the currency, the central bank increases its supply and thus pushes up its price. By selling the currency, the central bank decreases its supply and thus pushes down its price. The intention of these interventions is to bring the exchange rate closer to its equilibrium level. This is done by either increasing demand for the currency, through purchases, or decreasing demand for the currency, through sales. Interventions can also be used to influence the behavior of other market participants. For example, if a central bank purchases a large amount of a currency, it can signal to market participants that the currency is undervalued and encourage them to buy it. Similarly, if a central bank sells a large amount of a currency, it can signal to market participants that the currency is overvalued and encourage them to sell it. The effectiveness of central bank interventions is highly dependent on market conditions. If the market is overbought or oversold, then interventions may be ineffective. Similarly, if the central bank has limited resources or is unable to coordinate its interventions with other central banks, then interventions may be ineffective. Interventions can also have unintended side effects. For example, interventions can lead to instability in the currency markets and create uncertainty for investors. Additionally, interventions can erode the credibility of the central bank if they are viewed as inconsistent or ineffective. In summary, central bank interventions can be effective in stabilizing the exchange rate of a currency against other currencies. However, interventions can also have unintended side effects and can be ineffective in certain market conditions. It is important for central banks to carefully consider the potential benefits and risks of interventions before taking action.